Good afternoon, everyone. It's Bill and Wendy live from the room that has, and I'm not going to tell you what, if you guys will guess and put in the chat room what it is that we have our curtains tied up with, you're going to get a present. So that's our challenge to you. I want you to type into the comment section, what is that specific that's tying up our curtains? So
after that, we'll be right back.
That's right. Real quick, we are going to be getting into syndications and specifically in self-storage, because Wendy and I are really into self-storage. I know a lot of you guys are too, and we have a great guest to talk about that, but right after this.
We have a winner.
Alba, what type of microphone cable is that?
No, that is correct. That's
it is, but the specific type of microphone cable. But that's okay.
You're such a geek.
If you don't, know, we'll still give it to you. Anyway,
welcome. Give you the cables because I'm going to have it decorated correctly. So.
We were calling this studio industrial look.
Yeah.
So anyway, welcome to the show. Thank you so much for joining us on the Real Estate Investor Show, Hard Money for Real Estate Investors. We are Carolina Capital Management. We're lenders in the Southeast for real estate investors. So if you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Now, we only use 3 rules on the investor side. It's safety, reasonable rate of return, and simplicity. If you want to learn more, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up with Wednesdays with Wendy. Wendy devotes 30 minutes per person every Wednesday to talk about real estate. So there's the link. It's also in the chat on the right side or underneath, depending on the platform that you're viewing us from. And oh, by the way, we are now available on Rumble.
Yeah, ready to rumble.
We just love that guitar lick so much.
That's awesome.
That's awesome. Let's quickly talk about some upcoming events. We got Quest Expo.
Mm-hmm.
So there's a coupon code over in the chat as well. Get 30% off tickets. And it's Fairman 30. That's the age I wish I used to be.
Yeah, we were at one time, right?
Actually, I'd like to know what I know now at 30.
Yeah, that's for sure.
That would be awesome. All right. We're also doing you're doing something in Punta Gorda.
Yeah, a mobile home event. I need to get that information out. That's going to be in June. Actually, mobile home construction, how to finance them, put them on the lot, do all of that good stuff.
And then we have a investor cruise, I think, that is coming up as well.
Really?
Yep. Wow, that cuts off quick. I have no idea about the investor cruise. We'll keep you posted.
This is like just little clips. This is clip day.
All right.
Let's get to some good stuff.
Before we get started with our friend Jake, real quick, I want to talk about some breaking news, and then we'll get right into it. Listen, we had to get all of our
swear
graphics
there are
in.
no more. I swear there aren't any more. I promise.
All right. So this week they announced the producer price index for the month, and it was up to 11.2 something percent. So
It's crazy.
What that means are the wholesalers, the producer of goods and services, they're paying 11.2% inflation.
Mm-hmm.
So the consumer inflation was 8.5%. What does that mean? That means down the road, our inflation, as far as consumers goes, is going to be going up even higher.
Well, if you put the real numbers back in, which is cost, housing costs and utility costs and the cost of food. Oh, that's a nice shot. We're really looking at.
You like our carpet?
Yeah, you can move it now. We're really looking at 15, 20, big time percentage rates. I mean, it's bad.
Well, yeah. And with that, you have a bunch of companies that are doing their income for the quarter, reporting their numbers.
Mm-hmm.
You have Goldman and JP Morgan. All of them are giving guidance on volatility.
The sky is
They're
falling.
setting aside, I know Citi is setting aside something like $30 billion for loan loss reserves.
Yeah.
That's quite a bit.
Yeah, we've chunked ours up a little bit, and we're trying to sit on 4 to 6 months worth of cash reserves to run the business.
Yeah.
As well. So you just need to be cautious. We're in a time where we've never been in a situation like this in our world, with the high demand of housing, and now all of a sudden we've got inflation that's really high and interest rates are going up. It's just it's a big unknown. We just need to be cautious.
Yes, but like anything else, it runs in cycles.
Yeah.
So it's just a different cycle.
And it's a weird one.
That said, without further ado, sorry that I've bored you up to tears, Jake, sitting in the back, but welcome our guest, Jacob Vanderslice of VanWest Partners. Thank you so much for coming on.
Bill and Wendy, good to see you guys. Thanks for having us on again.
We're glad to have you.
Jake runs a fund that has, how many properties do you have currently?
We have 37 self-storage facilities.
In the fund. That's awesome.
And
well, a combination, we've got 2 funds. We're launching a third and some single asset syndications. So it's kind of a combination of all those vehicles.
Wow. That's awesome.
So what part of the country are they scattered, or you hitting certain parts of the country that you?
They're scattered to a degree. We've got a handful of deals in Denver and the Colorado Front Range, a bunch of deals in the upper Midwest, Southeast. We're in Florida, North Carolina, Tennessee, Ohio, Michigan, Illinois, Wisconsin, Georgia.
Wow.
So a lot of stuff in the
Midwest. Quite diverse.
What's that?
You are quite geographically diverse. That's good.
That's right. Geographic and cash flow diversification, right? We're more deal focused than we are market focused. I mean, when we can, we try to aggregate portfolios in a given submarket. We've got a few kind of clusters out there, especially in the Florida Panhandle and North Carolina to a degree. But we'll do a single asset acquisition in a new market if it makes sense.
Awesome.
So basically, what you're saying is that Americans in all parts of the country
need stuff.
Can't part with their stuff.
Yeah, it's a remarkable business. People spend $1,500 a year to store $1,000 worth of stuff.
It's crazy. It really is crazy. I don't get it.
Guilty.
He is. Totally
yeah, me
guilty.
too. I've got a storage unit myself. Yeah, just stuff that's out of sight, out of mind. I don't want to get rid of it, but I don't want it in my house. And there it sits and hits my credit card every month.
Yeah, it does. And that's the thing, is it's kind of an unknown. After a while, you don't really pay attention to it, even when they're raising your rates every 3 months.
Yeah, and if you're getting a rate increase, especially in this environment, most customers digest that pretty well because they're probably already getting a decent deal. And the disruption of getting a moving truck, calling up your buddies on a Saturday to find a new storage unit across town that you might pay the same price or more for, people just digest it and They know it's an inflationary environment, and they typically stick around.
That's right. That's right.
That made me just think of a neat little business model. If you could somehow call on these self-storage facilities as someone that would be happy to set up an eBay store and start selling some of this stuff for people at a, for a price, like a management fee to
But
list
then
this
you're
stuff.
getting them to move out of your place.
But then you're trying to talk your customers into not needing you any longer.
Yeah.
So it'd be kind of hard to do that.
It's an idea. We'll look into that. We'll report back on how it goes.
No, we don't want you to sell any of this stuff.
Yeah, that's for sure.
So, Jake, how has it been finding deals here in the last 6-8 months?
I've been saying this for a couple years, and deal flow is challenging, and it's been increasingly challenging this year. So Q1 of 21, we bought about $30 million worth of deals. Q1 of 22, we bought zero. Our first acquisition of the year is going to be this month rather. So deal flow is tight, and we're especially seeing deal flow tighten up on assets that already are producing income. We had a portfolio that we offered $24 million on, and we were maintaining our conservative underwriting, but we were still getting somewhat aggressive because we wanted the portfolio, and it sold for 33.
Wow.
So we can't make sense of what that buyer's model is showing them. They must be showing very high revenue growth, a very low exit cap rate. But we see quite a few examples like that out there. So we think there's going to be some pain in the market at some point, just with buyers that stretch too much. Interest rates are going up. But we're not seeing that yet. And in fact, even in spite of a rising rate environment, at least in self-storage, we are still seeing cap rates continue to compress, which is remarkable. The math doesn't make sense, and eventually, that's going to break.
Right.
But it hasn't broken yet.
Well, my thought on that is that if you're using cash or if your money is really cheap, then you can afford to buy in at that higher price and the lower cap rates. And then as those folks that are having to pay more based on leverage, eventually they're going to have to sell to you. So it's almost like I'm going to corner this market. I'm going to undercut everybody else's prices, and then I'll end up buying it from you or put you out of business, one of the two.
Right. Yeah. I think a lot of the shops that are buying at some of these egregious prices have a very low cost of capital and a very long view, but there's still plenty of buyers out there that are using pretty substantial leverage with very skinny pro formas. So we'll see how that shakes out in the coming months and years.
So what kind of credit do you give to a value add project? I mean, I'm assuming that what you're buying is value add to begin with, right?
Yeah, it depends on the type of value add. So we're sourcing really 4 different deal types these days. One deal type is what we've been sourcing for a number of years, and that's income producing out of the gates, but with the opportunity to increase revenue and increase NOI with more effective management. So that's kind of the first deal type. We'll call that income. The second deal type we're targeting are expansions. And that's where you buy an existing storage facility that's probably fairly full and somewhat new, and you build new storage units on excess land next to it. The third deal type we're targeting are lease-up properties. Let's say a developer builds a multi-story climate-controlled storage facility. They deliver it in January. They're in lease-up, whatever reason they want to blow out. We'll come in and buy it while it's in lease-up and then continue the lease-up execution. So we'll call that a lease-up deal. And the final deal that we're targeting are certificate of occupancy acquisitions, which means a developer builds a new storage facility. They're not an operator. They're not a manager. They just kind of build and move on. They make a 10 or 15% markup. We buy it brand new, but we buy it empty, and we lease it up and drive it towards stabilization. So those are all kind of the different flavors of value add that we're targeting out there. And it's all value add, but it comes in different forms.
Right.
Well, I like that last model because now you're not the one that has to worry about doing the development itself. And you're essentially doing outsourcing for your development, and you don't have to buy it till it's developed.
Yeah, you're eliminating the entitlement risk, the hard cost overruns. Somebody else digests that risk, and they make a profit for that risk. But as long as we're buying it at a cost basis that we feel comfortable with and makes sense, that's a deal that we're interested in.
Sure. Yeah, that's funny. I've not heard anyone else utilize that model. It's either a value add or they're developing it, and I like that addition. It takes a lot of the risk out.
It does. It does.
I've noticed a lot of people that are buying in the first one that you mentioned, where it's you have the ability to add. Maybe it was the second one, to add more storage, is making it climate controlled. That really seems to be coming more and more in demand, right?
Yeah, the pricing premiums that climate controlled units command versus non-climate controlled units vary by market, but there's definitely a premium in general. So if we're doing an expansion on an existing facility, we'll typically do a mix of climate and non-climate, just kind of depending on the market. You want to mix so that you can charge a higher premium for the climate controlled units, right? If they're all climate controlled on the expansion, then you can't really push prices as much as you could if you had 60% of your unit mix non-climate controlled at a lower price, and then pushing up that 40% of the unit mix that's actually conditioned.
Right. That's actually what I'm doing on a facility that I just closed on a couple weeks ago.
Okay.
There's a building there that I can easily turn it into climate control, and space where I can add a little more. So I'm really excited about it. I'll let you know if I'm sinking or swimming.
Yeah. And if you want to sell at some point, hopefully you give me a call first.
That sounds good. That
All
sounds
right.
good. Are you going to the show in Vegas next week, Inside Self Storage?
I am not. One of my partners is going. I'm going to make it to the one in the fall in Vegas, but I'm not going to make the April one, unfortunately. Just
awesome.
2 toddlers at home, and travel is tough.
It's tough. Yeah, I get it. I'm going. I'm taking my son with me. I took the advice of a dear friend and told my son that he can either learn it now while I'm here to teach him, or he can learn it later when I'm not here.
I'd say that's an easy choice.
It's scary, but true.
Yep.
Jake, do you mind, without getting too specific, obviously because we're not selling securities here, could you kind of give me an idea of how your investment model we'll just talk about your newest fund. How does that model look as far as an investor coming in?
Yeah, Fund 3 is an identical capital structure to Fund 2. So we have an 8% preferred return. All excess distributions above and beyond 8% go to return capital. And then for investors that come in under 500K, the split is 70-30 in their favor. Over 500 is 75-25, and over $1 million in invested capital is 80-20. The big difference between Fund 2 and Fund 3 is Fund 3, and by the way, we're in the very, very early stages of launching Fund 3. We haven't done our marketing blitz yet, so it's very, very raw, so to speak, but it's coming out soon. So the big difference between Fund 2 and Fund 3 is Fund 3 is going to have a more entrepreneurial, opportunistic buying box. Fund 2 is only buying deals with current cash flow and then increasing those revenue streams over time with more effective management practices. Fund 3 is going to target all the acquisition types that I touched on a few minutes ago. So it's all still self-storage, and it's all still value add and creating a good return and mitigating downside. But some deals will have no income for the first, no distributable cash flow, I should say, for the first year. Other deals will have distributable cash flow out of the gates, and we'll kind of balance all of them out together.
So is this fund going to be purchasing multiple property types? So you're going to get to a certain capital level and then start looking for deals, or it's going to be ongoing where you can continue to raise capital in it?
It's going to be ongoing. We're forecasting our deployment period to be about 2 or 3 years. We have never and will never force deals. So if we're not finding product that makes sense, we're just not going to buy anything.
Sure.
We've got a few deals in the pipeline right now that are pretty exciting. We have a deal in just outside Orlando, Florida. We got a couple new acquisitions that are teed up in Georgia that'll close in roughly Q3. So the pipeline is filling up, but the pipeline is certainly more weighted towards the growth deals versus the income deals. From a total return perspective, you can find income producing assets out there right now that might do a current 6 to 8 in the first year, but the total return on those deals might be a 9 to an 11% IRR. And that's just too low. That's a decent return. But relative to the risk profile, so much of your total return is reliant on that current cash flow, and then a very small markup and gain on sale at the reversion. So those are too skinny for us, and that's why we're a little more slanted lately towards the growth deal types in our pipeline. But that could rebalance again, in Q3 as we find an income producing portfolio that's off market that makes sense. But yeah, we raise capital as we make acquisitions. We're going to be trying to get as many commitments as we can up front when the fund publicly launches. But we've historically drawn down capital as we've bought properties.
Okay. So are your members equity members or debt members or a mixture of the two?
They're all equity. So they participate with ownership interest in the Funds LLC, which is a Delaware LLC, and it owns all the deals that the fund buys. So they have membership interest. All the depreciation flows through to investors pro rata with their contributed capital. So if somebody comes in for, say, 1% of the fund, they're getting 1% of the depreciation. So they are equity owners. They're not debt. But along with equity, comes a little more risk. You're not lending money to a borrower like you guys do with a secured deed of trust. And if they roll over, you take the property back. The implication of risk is a bit higher in an equity investment, but the upside arguably could be higher as well.
Sure. And you get to participate along the way as values go up. But at the same time, if values go down, then there's a little bit more risk involved in those. Historically, though, values don't go down. Over time, they go up, but you never know. I mean, there was a 2008, and housing went down. We're getting into a situation now where we have high inflation and rates are going up, but that doesn't mean values are going to go down. It just means, in my personal opinion, that on the
they'll sit longer. Single
family side of things, the appreciation percentage is going to start decreasing, but you'll still have appreciation.
Yeah, time, as you guys know, time cures all sins in real estate. The big question is, can you hang on?
There you go.
That is why we're so hyper focused on cash flow. Cash flow is what allows you to hang on. If the value of your portfolio, your property goes down, but it's still got a big cash flow margin, you can survive.
Yeah. Well, we talk about David Phelps and his saying all the time, the house does not care what it's worth.
Yep. And it doesn't know either.
That's right.
That's right. Yep. It's all about the cash flow. So as you're evaluating deals, I know cost of capital has been fairly low on the leverage side of things. If you're acquiring a property and you're going to put a certain amount of debt on it, that debt has been historically at low rates. Are you now reevaluating deals by using more of the fund capital to have much lower percentage of leverage on them?
Well, a couple comments on interest rates and debt. So on the interest rate side, obviously we're in a rising rate environment. They're going up quickly. We all forget that we're not even up to 2019 rates yet. Right. So the rates have not been this low for very long. And in 2019, were we all jumping out the window because of interest rates? No, we were doing deals and we were making sense of them. You just have to price in that interest rate risk. Like if you're buying a heavy value add acquisition, you're not going to get 10-year permanent financing, right? It's going to be more of a bridge product, 3 to 5 year maturity. So you're going to have to refinance that debt out if you don't sell it before the loan matures. So we're underwriting much higher debt costs on our takeout financing. We're not getting long-term rates locked up as much as we used to because long-term debt rates have gone up even more than short-term. So for example, we did a refinance on Fund 1 about 2.5 months ago, and we got a 4% fixed rate for 10 years, interest only. And that same loan product today would be 5.1%. And that's a big delta. And on a $25 million loan, that's over $250,000 a year in net cash flow that's not being distributed to investors. So I always say I'd rather be lucky than good. We got lucky when we refied that when we did. Who knew rates were going to go up as quickly as they did since then? But we're just pricing in that risk into our models. We're pricing in conservative interest rate risks on our takeout debt, conservative interest rates going in so that we're not surprised when we get a term sheet from a lender. We thought it was going to be 3.5 and it's 4.5.
Sure.
And as rates go up, eventually cap rates are going to have to increase. And I touched on this a moment ago, but we're not seeing that yet. And there's still very inexpensive credit facilities out there that borrowers are using as acquisition lines. Now, the short-term cost of those credit facilities is very low, but they're going to have to get permanent financing if they don't sell eventually. And the rates on that permanent financing are substantially higher than they used to be.
Mm-hmm.
But again, it's all relative, right? We're not even back at 2019 interest rates yet. The 10-year is up quite a bit today, but it's not where it was in 19. And 19, we were all doing okay, buying deals, just paying a little bit higher interest rates and pricing in that risk.
That's right.
Yeah, and I'm only talking about the rising rates when you're comparing to what they're trying to sell them for, the cap rates are trying to sell them for. So eventually when they sit out there a little bit longer and people say, sorry, this is not a deal, they'll start coming down on those prices a little bit to offset that. And I think as well, some of the lenders out there will probably start offering a lot more interest-only products to kind of offset that increase in rate as well. We're already seeing that in a lot of the long-term residential refinances for investors.
Interest only, it's a more aggressive loan type because you're not paying down principal over time.
Sure.
But if you're really focused on cash flow and you're a long-term holder, interest-only financing is a great vehicle.
Mm-hmm.
Now, amortization is a good conservative approach to real estate finance, but an amortizing loan, you cannot distribute amortization. The only way to monetize that amortization is to either refinance or sell. Mm-hmm. So you're paying down principal over time, but it's locked up in the property until you decide to monetize that.
That's right.
Both AMO and IO are good vehicles. It just kind of depends on what your thesis is and what your long-term business plan is.
Yeah, I'm really glad you said that. Explaining that to people sometimes is so hard they just don't get it. And that holds true whether it's a single family, multifamily, whatever you're doing. That statement holds true. And once people really wrap their heads around that, they can really scale up their business.
Yeah, and on a real estate income statement, as you know, amortization is not an expense.
Right.
So you're creating taxable income that you're not necessarily seeing with an amortizing loan.
Right. Good stuff.
Excellent, Jake. Listen, I appreciate you spending this time with us.
Yes, thank you.
Sharu, would you mind putting Jake's URL up there?
There you go.
If anybody is interested in investing in self-storage, Jake is an awesome dude, by the way.
He's the man.
And
Thank you both. Likewise.
Returns. They have a great business model. I would check them out. We love self-storage. Like we were saying, Americans just have this love affair with their junk. They don't want to get rid of it.
Yeah, that's right.
And you don't have to worry about toilets and plumbing and all that kind of stuff with a self-storage model.
That's for sure.
That's why we love it. There's much lower maintenance. You don't have to evict people.
Plus, when you want to passively invest, you invest with people that come recommended from a third party and that they know, like, and trust. And that Jacob definitely qualifies in our book for that, for sure.
Absolutely.
Well, thank you for the kind words, guys.
It's all truth.
Folks,
thank you so much.
We're wrapping it up. So thank you so much for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell and sign up with Wednesdays with Wendy. And we have a link to all the events that we're going to be part of in the next few months. There you go. There's a coupon for
That's
Quest
one of 'em,
Expo.
Yeah.
All
right.
Well, all right.
We got a meeting to go to.
Yeah, I'm running out of time. All right, folks. Had a great day. See you next week.
Have a good one. Happy Easter.